When you deposit money in a bank, most people assume it sits there, waiting, safe. It does not. The moment your deposit lands, the bank lends most of it out. That borrower spends it. The recipient deposits it in another bank, which lends most of it out again. New claims on the same dollar multiplied across the system. This is not fraud. It is how the system was designed to work. The money supply is not a fixed quantity. It expands every time a loan is made. It contracts every time one is repaid. What you call savings is not savings in the way you understood that word. It is a loan to a bank, backed by a fraction of what you deposited, in a currency whose total supply shifts with every credit decision made across the system. One deposit, one loan, repeated across thousands of banks. You deposit $1,000, the bank lends out $900. That $900 is spent and deposited somewhere else. That bank lends out $810, and so on. By the time the chain runs its course, your original $1,000 has supported many multiples of that in loans outstanding. No new wealth was created. New claims on wealth were created. The central bank sits above this process. It sets the rate at which commercial banks can borrow from it overnight. When that rate is low, credit is cheap, loans multiply, the money supply expands. The lever is real. So is the question of who decides when to pull it. Credit creation has funded genuine economic development, mortgages, business investment, infrastructure. The question is not whether credit produces value. It is whether credit should be created from nothing, by institutions with a structural interest in expanding it, at terms set by a committee rather than by the market. The expansion is not only imposed from above, it is pulled from below by households who want bigger houses, businesses that want to grow faster, governments that want to spend without taxing. This is not a design flaw, it is the design. The answer, at the level of the whole system, is claims. Not money in the way most people mean the word. Claims on money, backed by other claims, backed by a fraction of base currency, issued by institutions operating on the assumption that not everyone will ask for their money back at the same time. That assumption is usually correct. When it is not, the result is a bank run. Approximately $1.85 trillion in hedge fund Treasury basis trades, concentrated largely in the Cayman Islands, running at leverage ratios of around 50-1. These are positions that likely exceed the scale of the fragility that broke the Treasury market in March 2020, the moment when the supposedly safest asset in the world stopped functioning as a liquid market and the Federal Reserve had to intervene directly to prevent a collapse. That episode revealed something the system would prefer to keep quiet. Treasuries, US government bonds, the bedrock of the global financial system, are risk-free only if you can hold them to maturity. Silicon Valley Bank could not. It held long-duration bonds on the assumption that rates would stay low. When rates rose, the market value of those bonds fell. Depositors noticed. The bank failed in 48 hours. The machine is larger now than it was in 2020. The leverage is higher. The positions are bigger. 2 crises, 2 rescues. The machine kept expanding. Go back to your deposit. What you have is not money in a vault. You have a claim on a bank that has lent most of your deposit to someone else, funded in part by overnight borrowing from a central bank whose balance sheet has expanded by trillions in the past 2 decades, operating in a system where the largest participants run leverage ratios that would be considered reckless in any other context. None of this is secret. The people who built this machine are not villains. They are operators of a system whose structural incentive has always been expansion. A system where money expands faster than productivity requires nominal growth to mask the debasement. The incentive to expand the money supply is not incidental, it is structural. Understanding this is different from being outraged by it, but it is worth understanding. What you call savings is a claim on a system that has a structural incentive to expand. Knowing that is the beginning of asking what saving actually means. This is the Cantillon letter. Monetary truth. Understand it first. Subscribe and visit us at cantillonletter.substack.com.